Silver investors, stop everything and listen. It is Sunday, February 2026. In hours, the market opens again on Monday, February 2. After the last 48 hours, this is not a normal open. This is a pressure test. Here's what just happened in plain language. On Thursday, silver hit a historic high near 121.64 an ounce. Then the air came out. By Friday's close, we were around 84.70. That is roughly a 30% collapse in about a day. When a market moves like that, the biggest threat is not the price on the screen. The biggest threat is your reaction. People blow up accounts and sell the bottom because they treat a volatility event like a permanent verdict. So before Monday, you need a map, not a prediction, a map. Three forces are colliding at once. Force 1, the macro reset. Over the weekend, expectations shifted toward tighter conditions and a firmer currency environment. When markets suddenly believe money will be less easy, the first thing to unwind is the crowded hedge trade. Metals often take the hit because they were the obvious place to hide during the run-up. Force 2, the margin reset. The futures exchange has raised margins on silver from about 11% to 15%, effective at Monday's close. That sounds small until you do the real math. It is a large jump in cash you must post to hold the same position. If you are leveraged, you may be forced to sell simply to meet requirements. That is not opinion. That is mechanics. Force 3, the psychological reset. Silver did not gently drift below 100. It broke it violently. Round numbers matter because they are the story people tell themselves. Above 100, the story is new era. Below 100, the story becomes bubble. That narrative switch changes how every bounce behaves, because bounces become exits. Now let us talk levels, because Monday will likely revolve around a few simple zones. 100 is now major resistance. If price cannot reclaim and hold it, expect rallies to be sold hard and fast. 84.70 is the pivot. It was Friday's close. If we gap down below it at the Asian or early European open, it signals fear is still in control. If we reclaim it quickly, it signals the market is trying to stabilize. 90 is the Monday sanity check. If silver cannot regain 90 during the main Western trading hours, a lot of traders will label the move a dead cat bounce and prepare for a second flush. 70 to 77 is the next battleground. This is the zone where buyers will try to prove this was forced liquidation, not a true demand collapse. If real buying shows up there, it often shows up with speed, not with hesitation. You may hear people throw around 50 as a fair value target. Treat that as sentiment and fear talking. In panics, extreme targets appear to justify emotions. Your job is to watch what price does, not what people say. Now the most important part, what do you do on Monday? We are going to split this into two groups: physical holders and paper traders. If you hold physical silver, your job is not to win Monday's candle. Your job is to avoid becoming a forced seller. Volatility does not change silver's utility overnight. Solar manufacturing, electrification, and electronics do not pause because futures got liquidated. Supply also does not magically surge because spot fell. Most silver is produced as a byproduct of lead and zinc. You cannot flip a switch and produce more just because the chart is dramatic. So for physical holders, the playbook is simple. Do not panic, sell into the open. Let the market show its hand first. If you were holding for a multi-year thesis, a brutal correction is not pleasant, but it is not automatically the end. If you trade paper, your job is survival and timing. Here is the leverage truth. If the margin change can force you out, you are not holding a position. You are holding a fuse. So the Monday rule is, do not be first. If we open below 84.70 and cannot reclaim it early, assume forced selling is still unfolding. In that case, do not chase the first bounce. Let the liquidation wave pass. Forced selling tends to cluster during the active session when brokers and clearing firms tighten risk and accounts get squeezed. That is when real lows form, not when fear is still expanding. If we open above 84.70 and push toward 90 during London and early New York, watch the quality of the move. A healthy rebound climbs in steps, with pauses, and it does not immediately get slammed back under the pivot. A weak rebound spikes and fades, because it is powered by short covering, not fresh conviction. Now let me explain why margin changes create bizarre price action, so you do not misread it. When margins rise, every leveraged long needs more cash, immediately. Some traders have the cash and simply post it. Many do not. And when they do not, they sell whatever they can, as fast as they can. That selling has nothing to do with whether silver is scarce, or whether solar demand is strong. It is forced selling. It is plumbing. This is why you can see a market drop into a zone that looks cheap and still keep dropping. Cheap does not matter when someone is compelled to exit. It is also why the first bounce is often a trap. The first bounce is the market inhaling. The second move is the market exhaling again after the next wave of liquidations hits. So on Monday, assume the tape will be emotional. Spreads widen, stops slip, social media gets loud, and your brain will try to turn a fast-moving picture into a simple story. Resist that. Here are 3 Monday scenarios and how to think about each one. Scenario 1, a gap down and an early flush. If we open weak and pressure accelerates, the market is searching for the level where forced selling ends. In this scenario, strength is not proven by one green candle. Strength is proven by a failed breakdown. That looks like price pushing lower, failing to continue, then reclaiming the pivot and holding it through multiple pushes. That is how bottoms form. Scenario 2, a flat open and a choppy range. If we open near Friday's close and move sideways, that is the market negotiating. It means buyers and sellers are both cautious. In this scenario, the biggest mistake is overtrading. Sideways action after a crash is often a pause before the next decision. Wait for the break and the retest. Let the range resolve. Scenario 3, a surprise gap up. If we gap higher, do not assume the storm is over. Many gap ups after crashes are short covering and relief. In this scenario, watch whether the market can keep gains during the first pullback. Real strength holds, consolidates, and then continues. Weakness spikes, celebrates, and then collapses back into the gap. No matter which scenario shows up, here is what you should not do. Do not place an impulsive market order in the first minutes of the open. Do not average down with leverage just because the price is lower than Thursday. Do not anchor your decisions to the 121 high. The market does not care what you wish it would do. Do not confuse a strong story with a safe entry. Finally, keep one principle in mind that separates professionals from gamblers. A correction ends when sellers run out of urgency. So, you are watching for urgency to fade. That is visible in the behavior. The sell-offs become smaller. The rebounds become more orderly. The market starts respecting levels instead of slicing through them like they are not there. If that happens on Monday, you do not need to catch the exact low. You simply need to stop being on the wrong side of the next phase. Now, there is one signal almost nobody watches, and it matters more than your favorite indicator. Watch the difference between paper price and real-world availability. If spot drops but retail premiums rise, if delivery times stretch, if dealers suddenly have less inventory even though price is lower, that is a clue. It suggests the sell-off is happening in paper, while physical remains tight. That is how a structural deficit can hide inside a scary chart. On the other hand, if spot drops and premiums also collapse, and inventory becomes easy everywhere, that suggests demand really stepped away. That is a different situation. So, on Monday, do not just watch the chart. Watch behavior. Watch how price reacts to 100 as resistance. Watch whether 84.70 becomes support again. Watch whether 77 attracts real demand or just temporary buying. Watch the speed of the tape. Panics move fast. Stabilization slows down. And keep your emotions in check because the market will try to hypnotize you. Here is the trap. After a crash, you will feel an urge to do something immediately, just to feel in control. That urge is expensive. The professionals do not need to be first. They need to be right after the market reveals the phase. So, let us name the phases. Last week was trend. This weekend is correction. Corrections are chaotic. They punish certainty. They punish leverage. And they punish anyone who confuses a story with a timetable. Now zoom out for one big perspective point. The gold to silver ratio recently compressed to below 60. That tells you silver still has higher velocity. It tends to fall harder in liquidation, but it can also recover faster when pressure lifts. If the currency strength trade cools, silver often snaps back with surprising speed. Again, not a promise, a pattern. So here is your final preparation before the bell. First, define your risk. If you cannot survive another 10% swing, you are size too big. Second, decide your levels in advance. 100, 90, 84.70, 77, 70. Third, commit to patience. Let the first wave show you whether this is stabilization or another flush, because Monday will reward preparation, not emotion. Stop everything, breathe, and let the market show you the truth, one level at a time.